$20,000 of your retirement savings is quietly at risk from one thing most investors ignore: Fed policy mistakes. Most people think the Federal Reserve only matters for big banks and economists on TV. That belief is wrong, and it's costing middle-class families real money right now. If you have a 401k, an IRA, or a brokerage account, the Fed's next decision could quietly erase years of contributions before you even check your balance. By the end of the next 4 minutes, you'll know exactly how Fed policy mistakes cascade into your account, which sectors get hit hardest, and the one strategy that can protect your investments when the Fed gets it wrong. Stay with me. First, let's close the belief gap. Here's what most investors assume: the Fed's decisions don't really touch my 401k directly. They affect Wall Street, not me. That's wrong, and here's the proof. According to research published in the Federal Reserve Economic Review, a single 1% change in the federal funds rate triggers approximately a 10% move in stock market performance. That's not a suggestion. That's a documented pattern across 40-plus years of data. Let's put a number on it. Imagine a married couple with a $200,000 investment portfolio, a realistic middle-class retirement nest egg. A 10% market decline from a Fed policy error means a $20,000 loss. Over a 5-year period, if the Fed makes multiple mistakes, tightening too aggressively when inflation is already cooling, for example, that couple could face $40,000 to $60,000 in cumulative losses that directly impact their retirement timeline. That's the delta. That's why this matters now. But here's the worst part. It's not the headlines moving your portfolio, it's the math underneath them. When the Fed raises rates, borrowing becomes expensive. Corporations that rely on cheap debt to fund operations see earnings shrink. Stock prices fall because future cash flows are worth less in a higher rate environment. Bonds that were paying 2% become less attractive when new bonds pay 5%, so existing bond prices drop to match. Your portfolio doesn't move because of news, it moves because the discount rate on future earnings just changed. The Fed controls that lever. The problem is timing. The Fed often gets it wrong. In 2022, the Fed kept rates near zero while inflation hit 1%, the highest in 40 years per BLS data. By the time they started raising rates aggressively, the damage was baked in. Investors who held growth stocks and long-duration bonds got crushed. A $300,000 portfolio could have lost $60,000 in 12 months because the Fed was late and then overcorrected. Now let's talk about which parts of your portfolio are most vulnerable. Data shows that sectors with high debt loads and long earnings runways suffer most when the Fed tightens. Technology, real estate, and utilities are the most sensitive. If you're overweight growth stocks during a Fed policy mistake, you're exposed. Conversely, when the Fed cuts rates unexpectedly, these same sectors rally hard. This is where most middle-class investors fail. They build a portfolio in 2019 when rates are low and never adjust as Fed policy shifts. Then in 2023, when the Fed raises rates 5 times, they're shocked their portfolio dropped 15%. Here's the strategic shift. During periods of Fed policy uncertainty, diversification isn't just about owning stocks and bonds. It's about owning assets that respond differently to rate changes. That means holding some inflation-protected securities tips, some short-duration bonds that don't get crushed when rates rise, and some defensive sectors like utilities and consumer staples that hold up when growth stocks fall. Research from the past 3 recessions shows that utilities outperformed the S&P 500 average by 3-5% annually during Fed tightening cycles. That's not exciting, but it's how you protect a $200,000 portfolio from becoming a $170,000 portfolio. The second layer: stop assuming the Fed will get policy right. They won't. Build a portfolio that works if rates go up, if they go down, or if they stay flat. That means your asset allocation should have ballast, stable value positions that don't move with Fed surprises. Your retirement plan depends on it. If you're counting on 7% annual returns and you lose $20,000, $40,000 to a Fed policy mistake, you've just added 2-3 years to your working life. Most people don't think about Fed risk in those terms until it's too late. The full strategy, with the exact sector rotation data, the rebalancing checklist, and the 5-step portfolio stress test, is covered in depth in the companion book, Market Cycles Decoded. Link is in the description if you want the spreadsheets and case files I couldn't fit here. Here's your takeaway. Fed policy mistakes are predictable in direction, not timing. Build a portfolio that survives multiple Fed scenarios, not just one. That's how you protect your $200,000 from becoming $170,000. If this video changed how you think about Fed risk in your portfolio, hit subscribe. I'm covering sector rotation strategies in the next video, dropping Thursday. Ring the bell so you don't miss it. What's your biggest concern about Fed policy and your retirement? Drop it in the comments below. Markets reward the patient and the prepared.